Welcome to this video on hedgers. In this video, you will learn about hedging and hedgers. Hedging is a way to offset the loss from a negative event. For example, when an individual buys car insurance, it reduces the effect of the negative event, though it does not ensure a negative event from happening. Drawing parallel lines in trading and investment, hedging is a risk management strategy used to limit or offset the loss in existing positions from the fluctuation in the prices of the assets. Consider that you as an investor has built a portfolio to benefit from long-term capital gain. Also, your portfolio has started churning good returns. However, due to any adverse event, you believe that the market would go down, and eventually it will affect your portfolio returns as well. In this case, you can either buy stock negatively correlated to your portfolio, or you can short sell other derivatives instruments such as futures to hedge your portfolio. Now that you understand what hedging is, let's learn about the people who do it. Investors who usually hedge their trading positions are referred to as hedgers. They take steps to reduce the risk of an investment. By making an offsetting investment, they try to avert the risk in the market by taking the opposite position of what they already hold, and make themselves neutral to market movements. Colloquially, in financial markets, traders call unhedged positions naked positions, as they expose them to financial risk. They call hedged positions as covered positions, because they cover the risks to which naked positions are exposed. Also, hedgers like to trade in liquid markets where transaction costs are low. It allows them to set up and remove their hedges cheaply. Now that you know the concept of hedging and who hedgers are, let's understand why traders hedge their position. Let's understand this with the help of an example. Consider a trader who, based on his research, expects a specific banking stock to go up. Accordingly, he speculates and buys the stock. However, soon after the transaction, negative news about the banking sector surfaces in the market. Hence, the trader now feels that his stock price would fall in the short run. Given this, he can take steps like do nothing and let the price of the stock fall, or sell the stock and buy when its price would have fallen, or hedge the position. If the trader chooses the first scenario, he would have to wait until the stock price bounces back to its buy price. In the second scenario, the trader would lose the opportunity if the stock price didn't fall and instead increased. Also, selling the stock and buying back again involves transaction costs, and sometimes it is not feasible to do so. For all these reasons, hedging makes sense as it virtually insulates the position. When hedged, the trader can be rest assured about the adverse movement in the market, as it will not affect his position. Hedgers trade to manage the financial risks they face. The risk that prices will change for the worse is called price risk. Traders use many instruments to hedge their financial risks. Futures and options contracts are frequently used by hedgers to hedge their risks. That is all for this video. You learned the concept of hedging and traders who perform hedging in financial markets.